Hello and welcome to the second episode of the Ravenpack Chat with the Expert series. My name is Ashish Sharma. I'm the Head of Business Development here at Ravenpack, and I will be moderating the session today. For those of you who might not know Ravenpack, we are a pioneer and leader in the alternative data and big data analytics space, with over a decade of experience in helping investment management firms deriving value from unstructured data sources. The objective of the Chat with the Expert series is to provide a forum for the audience to hear from and interact with industry experts on alternative data and big data analytics. The topic we will be discussing today is the interaction of news, social media, corporate events, and global macro. The session is co-hosted with our partner, Wolf Research. Our presenters today and experts are Yin Luo, U.S. Quantitative Research, Economics, and Portfolio Strategist at Wolf Research, as well as Peter Hafez, Chief Data Scientist here at Ravenpack. During the presentation, all participant lines will be muted. However, you can ask questions at any time using the online Q&A feature. These questions will be answered at the end of the presentations. And before I begin, I would like to take this opportunity to remind our audience based in the UK that we will be holding our annual research symposium in London on May 23rd. This year, the agenda will focus on data monetization, data privacy and protection, specifically for systematic and fundamental investors. Participation is upon invitation only, and registration is available through the link you can see on the screen. And with this, I will pass it on to Peter and Yin to kick things off.
Hello, Yin. Thank you very much for doing this webinar with us. We are very happy to have you here, and I'm sure that the audience is looking very much forward to hearing what you have to say about the alternative data landscape and about NLP. We have known each other for quite some years, I guess almost 10 years by now. You were one of the early pioneers in the alternative data space. Back then, I guess alternative data wasn't really coined as a term when you got started, but you were very early looking at news analytics and sentiment data for the financial industry. And over the years, of course, you have had a lot of experience with continuous work in this area. And I think that kind of opens up for some very interesting conversations that we can have around this topic that hopefully can inspire our audience to see how they can take advantage of alternative data in their investment process. So with all these years behind you, what's your experience with alternative data? Where is the value? And also, do you see this mostly being for quants, or is it also something that could be interesting for more fundamental investors?
Oh, thank you. Thank you, Peter. First of all, thank you for having me today. I think, as you mentioned, yes, we've been working with all kind of data for a long time. Our views, I think, on alternative data is one. First of all, of course, you have to define it. So what is really alternative? The words itself also evolve over time. Right? So maybe 20 years ago, even analysts estimate data was somewhat of alternative. Maybe 10 years ago, news sentiment was something very new and innovative. But I think, of course, as you mentioned, embracing different kinds of data, I think the words itself also evolves. Number two is we always been very bullish on alternative data. As you mentioned, is the first time we started to work with Ravenpack with you was more than 10 years ago. I think our view is with alternative data is number one, they may not necessarily have a better performance than our traditional, let's say, when I say traditional here, I basically refers to company fundamental data or broader economic data. I think performance may not necessarily better, but at the very minimum, they should provide a great diversification benefit. As more and more investors starting to embrace the data, obviously, they may eventually getting arbitraged away. But in our experiences, from the day that when investors realize this data may be interesting to the time until they test it, committing the time to test it, committing the time to invest in it, and all the way until the data or the value getting arbitraged away may still take a long time. Number two, I think we do believe alternative data providing not only just diversification benefit, in many occasions, they also adding some very interesting angles, not only useful for quants, but I think it's more importantly, from what we see, the biggest investors actually starting to embrace alternative data in recent years is more from the fundamental community, which is actually quite interesting. I think part of the reason is many kinds of alternative data are really kind of industry specific, country specific. They may not necessarily covering large number of companies. But so quants traditionally think about the breadth. They want a data source to cover as many companies as possible. Number two, they also want histories. If you say, I have a really interesting data, but I really have about 2 or 3 years of history, I think most quants will probably turn away. So this is kind of a part of the reason we're seeing some of the early adopters obviously was in the quant community, but in recent years we're starting to see more and more non-quants, or we call it fundamental discretionary investors, also starting to invest in alternative data. And I think even more interestingly is the way that quants and fundamental investors, when they look at alternative data, they tend to see it from a very different angles. So not necessarily competing with each other. And a simple example is most quants, when we take on alternative data, the first thing we do is either traditional factor backtesting, which I will show you a few examples in a second. In a way, is you're trying to structure your signals and trying to predict stock returns directly, versus what a fundamental investor would do is you're taking interesting data source, maybe not necessarily covering a large number of companies, but most of the time, you don't necessarily want to predict returns, stock returns directly. What you want to understand is what is new piece of information telling me about a company that I don't know, or what is the new information can help me to understand a company faster or better than just using the traditional data. Right? So in many cases, it's more about understanding the company, understanding the business model, understanding the KPIs rather than directly predicting stock returns. That's not how they would use the data directly anyways. So I think this is kind of an interesting way to see how they will use the data in a very different way. I think quickly summarize is we definitely very bullish on alternative data. We think at the very minimum, they provide a great diversification benefit. Right? So when you think about the equity world, last year, 2018, or this year in 2019, I think it's sort of a classic example where the traditional factors such as value, momentum of earnings revisions, especially in the U.S. equity market, has been struggling in the past about a year and a half. Again, when we look at the performance of most of our alternative data-based factors and models, and I would not necessarily saying that performance in the past year and a half is better than the previous years. All I'm saying is the performance is not materially different from the previous years. Of course, in this case, it's a classic example how they can add this diversification benefit.
Yeah, you touch on a lot of very interesting topics here, and I'm looking very much forward to hearing more throughout your presentation. One of the things that has definitely changed over the last, let's say, 10 years is that there's a lot more data that has become available of different types. And some of that, of course, is driven by an increase in compute power, but also just generally that there are more, we have seen the proliferation of social media platform, and also just generally an increase in devices, mobile phones and so on that people are carrying around, and that generates a lot of new data. We're also seeing, of course, that a lot of this new data that is emerging uses new, technology like natural language processing. So that has also helped increase the number of data sets available to investors. What is your general view on natural language processing, and also throwing in, more specifically sentiment analysis into that mix?
I think from what we see it is the vast majority of the information obviously is in a sort of unstructured format. So the actual information is actually in the data structure in the traditional matrix format is actually a fairly small percentage. The vast majority, of course, is in the audios and videos and written context. Textual information still tend to dominate. We have studied and then tried many kind of techniques to analyze anything from visual to the satellite and various kind of ultimate data. I think that the technique is definitely there, and the computing power is definitely has matured. But I think the most fruitful areas of research, and we can do more, at least in the near future, is probably still in the textual analysis. So again, it's going back to textual analysis, going back to NLP. I do think, again, given the advancements and the research has done in the past decade or so, we still think there's tremendous a lot more we can do by further extending our natural language processing techniques. I think the current technique is still fairly say rudimentary. We only just exploring the surface about analyzing some basic sentiment and some basic linguistics. Of course, how human actually would understand the language is very different from how the machine can understand. So I think still there's a long way to go, but it's actually fairly positive. It means in the future, in the next couple of years, as research getting more and more mature, we can probably generate even more interesting information from the textual data. So this is definitely one area we continue to invest in. And the other thing I want to mention is we're also seeing not only just taking the data directly off the shelf, but also how you would want to use it, how you want to interact. For example, just the sentiment generating from the news or from social medias, how we want to understand how investors would interact with a different kind of news. Right, so this is again some of the topics I plan to talk a little later today. This is looking at the interaction of sentiment, news, behavior biases, but also the sort of attention arguments. So this is where we think is by not only just looking at every single piece of data in the isolated basis, you also want to interact and brain and combine them together with our traditional understanding about finance, about behavior finance. I think this is one area we'll continue to invest in.
I think we can probably continue discussing this topic throughout the entire webinar, but I think we should probably turn to your presentation at this stage and then leave the rest of the questions for the end of the presentation, where we can also open up for the audience to ask their questions.
Thank you, Peter. So with that, let me switch to my main presentation. So on this slide, I have some of the background papers. I think the main one I plan to use today is basically number one, Beyond Fake News. This again, we're quite grateful for Ribbonpack providing the data to us on a continued basis over the past decade. So this is our latest work of using your data. The second paper I want to briefly mention towards the end is called Trading the Trade War and Brexit. So this is slightly switching the gears on different topics. We have also done some of our own NLP analysis, which I don't plan to cover today, but what is using our NLP some of the record findings as the other analysis on management conference calls. So this is, again, as I mentioned, is the main papers, and the idea was how can we look at a news sentiment and adding, as I mentioned earlier, by adding this behavior finance arguments or angles on top of it. Obviously, the traditional argument is you're buying on a positive sentiment, you're selling on a negative sentiment. The whole assumption is based on the investors underreacting to news. Right? So when we see a piece of positive news, we are likely to trade on it immediately. Most investors are probably not convinced. They will tend to wait until they see further confirmations. And this is what, of course, the whole argument behind the post-earnings announcement drift, one of the most widely studied area in corporate finance. And the same argument applied to other corporate events, and the same argument applied to a news sentiment is investors not necessarily to act on the news immediately, which leading to the post-announcement drift in the same direction, meaning positive news tend leading to further positive news, investors underreacting, which leading to the stock tend to drift positively in the same directions, and the same argument applied to negative news. We're going to look at from a slightly different angle in this research. But first of all, let's look at the headline sentiment signal ESS computed by Ribbonpack directly. And this is, again, going back to the early conversation with Peter. We started using Ribbonpack data over a decade ago, back around 2009. When you look at the data, especially the bottom right-hand side chart, as you can see, this is a simple signal when we try and apply the Ravenpack sentiment signal on a monthly horizon. Right, so we also have some of the other research when we look at the sentiment data from a sort of a higher frequency trading angle. In the intraday perspective, the data is still highly useful. But even at a daily, sort of a slightly less than a week horizon, we still find the sentiment signals adding a significant value to our statistical arbitrage models. But obviously, the conversation today is mostly geared towards longer-term measures with a holding horizon probably beyond a day, beyond a week, or beyond a month, probably into a multiple months or even into the years. So at the monthly horizon, what you can see is the signal performed fairly well from 2006 up until maybe around 2012, and since 2012 has been flattening out. So this is again one of the trouble issues. As the signal has become known to more and more investors, as more and more investors starting to use, we're starting to see the signal decay. Still useful in the higher frequency domain, but probably starting to see some struggles at the monthly horizon. You can sort of see the same chart at the upper right. Right, so the performance was fairly strong in the past, but in recent years has become more volatile. And this is sort of the goal of how can we do a little better.
Yeah, so it seems to be the biggest challenge to make it work on longer horizons, especially in more recent years. But I know you have been doing quite a bit of research in this area, and I'd like to hear more about what do you suggest people to look into if they want to overcome this issue?
Yeah, no, I think, Peter, that's a very good question. I think the goal, as I mentioned earlier, is really number one, trying to see how investors react to the news. Number two is really bring in some of the latest machine learning techniques that we've been using in recent years. I think this is, again, one, behavior finance. Number two, machine learning can really help us to extend the investment horizons beyond a few days. Actually, as you can see later, we can actually make the signal useful even to a fairly longer term buy and hold investors. So the first simple thing we can do, obviously, is we can try various forming windows, right? So rather than computing daily signals, daily sentiment, we can aggregate a sentiment over the past month and 3 months and 6 months and 12 months and so on and so forth. As you can see at the bottom left-hand side chart, the 3 months appears to be a sweet spot where we do strike a good balance. The signal is still fairly up to date. At the same time, the turnover has declined tremendously, but we also have a fairly strong signal at the 3-month horizon. So for the rest of the study, we're going to use the 3-month horizon as our baseline, and what we want to see is we can further slow down the signal by interacting with the investors' behavior biases. The next thing I want to show you is this is, again, one of the main tools we use by combining investors' behavior bias with news sentiment, which is via the event categories, also predefined by Ravenpack. Right, so as you can see that from the upper chart is the vast majority of the news is related to certain corporate events where earnings and revenue related news tend to dominate. They account for 80–90% of the news. On the other side, you can see the product and services, the labor issues, the credit ratings, the legal issues. They can be quite useful. But these, of course, are events that tend to be fairly rare events. They don't have a lot of numbers, but again, they're probably also not well covered by other data sources, and investors may not necessarily paying attention to this kind of news. The bottom chart shows you the average, but also the distribution of the sentiment by corporate events. The interesting one, obviously, are the legal events. You can see the distribution is very wide. On average, legal events are probably more like a negative news. This is when company had a lawsuit and facing regulatory investigations and so on and so forth. But obviously, if once a company settle the events, then you can see the sentiment can be extremely positive. On the other extent, when you look at explorations, is mostly likely on oil and gas companies and mining companies finding some new resources. So on average, of course, the sentiment is fairly positive. Distribution is also fairly tight. Right? So you can see different kind of events, the sentiment can be very different. We also try to explore the diversification benefit. So this, again, we look at some of the headline sentiment computed by Ravenpack and how they correlated with ESS signals. Right, so the CSS and MCQs on both sentiment, what NIP is more around the volatility, which tend to be somewhat negative correlated, where you can also see the same thing as is when we look at the credit and legal issues, this is where we're also seeing some of the bigger diversification benefit. I want to start it from the investors underreaction assumption. This is a driving force behind the post-event drift, meaning investors don't fully account for the information in the news, which means when they see a positive news, they don't necessarily buy at the same time. They want to see and wait and see further confirmations, which is where we're leading to this post-event drift. The classic examples are what we call the non-market moving news, meaning the minor positive news or minor negative news that most investors understand, but they're unlikely to act on it immediately. A classic example would be, so for example, buyback news. Right, so this is the bottom left-hand side chart. You can see the vast majority of the buyback news are positive, which is the blue line. We're just starting to the access returns 60 days before and also 1 year post the event is all in the trading days. And what you can see is obviously on the event date, which is when the company is saying we're going to do buybacks, we'll give you an update on the buyback status. So most of the buyback news are related to updates on the status of the buyback. Right, so obviously most investors are unlikely to buy immediately when they're seeing updates. The stock does react positively on announcement day, but it's very minor. What is interesting, however, is the post-event drift tend to be fairly significant. So in the 1 year post, the company make an announcement, you see stock tend to rally by about 3% also, and it's also fairly consistent. And this is the beauty, because if we are not high-frequency trader, without trading in the intraday horizons, once we see the buyback news, this is where we can act upon it. You can see we can capture some of this post-event drift. The same argument applies to same-store sales, right? So this is obviously have a very different coverage. The sample size tend to be smaller. This is mostly related to companies saying this is more about the retail companies and so on and so forth. You see the same argument is investors tend to underreact to the news, which leads into a fairly strong post-announcement drift. On the other extreme, when you look at the big market moving news, right, so classic example would be the credit rating changes. Obviously, for equity investors, they are unlikely to care about the credit rating upgrades. So if a company's bond is being upgraded from a AA to AAA, investors are unlikely to care much about it. But on the other side, the credit rating downgrades is likely to trigger investors' concerns, especially when a company's bond is falling into the junk bond status. In recent years, we're also seeing the strong reactions on one level just above junk bond, right? So changing from a single A to double B also play a fairly significant role, not only just from, let's say, triple B into a double B status. The same argument also applies to a clinical trial, so this is actually even stronger, right? So the red lines is all we care about now, right? So this is mostly applied to biopharma companies. When they receive a letter from FDA, the FDA never really reject the applications, mostly in the form of complete response letters. Basically, the thing is at the current status, the development of the new medicine is not approved. You have to go back and do more work. This typically causes a major market sell-off. You can see once a company receives that letter, make it public, stock tend to fall around 14% on the same day. And this is a classic example, investors overreacting to, more likely to bad news, but some occasions can also be overreacting to good news, which lead into a reversal patterns. Reversals tend to be much smaller than the post-event drift you see on the previous slides, but this is also a sweet spot we can capture. Right? So the basic argument is investors are not reacting to the news in the same way. Some news, they underreact, which we can invest in the same way to capture the post-event drift. Some other news investors may overreact, which we can probably capture this sort of a reversal patterns. We'll look at probably hundreds of different kind of events, but rather than manually drill down to each one of them, what we decided to do is let the machine do the work for us. But before we jump into machine learning, I also want to mention one more thing, which is news volume. This is also one way to capture investors' attentions, right? So again, the volume of news actually also tell us something interesting, right? So the question is no news good or bad? Actually, it depends. For some news, let's say, for example, earnings and revenue related, actually more news are related to investors' attention, which is actually a positive signal. On the other side, when you look at executive appointments, M&A related news, actually no news can be a good news. Right, so what we try to do is let the machine to look at the sort of a complex relationship among the three different drivers. One is sentiment, one is attention, one is corporate event, which is also a proxy for investors' overall underreaction. So what we did was using sort of a two simple machine learning technique. One is the lasso technique, which is on the linear side. One is XGBoost, which is nonlinear classification model. Right, so design will be a little different. In the lasso design, we're trying to predict stock returns in a sort of a point estimate. Lasso is just a more like a robust regression framework. Versus XGBoost, which is a nonlinear model trying to do classification. We're trying to classify whether stock will outperform or underperform in the investment horizon. So you can see the two models are somewhat complementary. The two slides the two pictures on this slide that shows you some of the high-level intuitions. One is for legal event, which is on the bottom left-hand side chart. One is for revenue event. You do see they have a fairly nice mix of event counts, event sentiment, and some of the other sort of a mix of different signals. Right, so we do seem to have a fairly balance from different categories of signals. On this slide, you can sort of see the trade-off of event coverage versus performance, where we use a rank IC. Again, here rank IC is defined as a correlation between our signal versus next 1 month's return. You want it to be as high as possible. The coverage is refers to the right scale, right-hand scale, which is, of course, you want it to cover as many companies as possible. Right, so obviously, for earnings-related news, we find the signal is very strong. We also have a fairly decent coverage. But later on, you're going to see is the signal, unfortunately, somewhat correlated with earnings revision type of signals. Versus same-store sales, so the second one you can see has very strong performance, actually almost as good as earnings, but the coverage tends to be fairly poor. But on the positive side, the signal is not highly correlated with some of the other signals. So we're going to have to make a decisions about coverage, about performance, and also correlation we're going to see in a second. The bottom chart you can see is this machine learning driven signal does outperform the off-the-shelf sentiment signals directly in most applications. Right? So this again does highlighting interacting with behavior biases and using machine learning technique does seem to add some incremental value. The next slide shows you is given we have a different kind of news categories which have a very different coverage, we can obviously further combine them together into one. And this is a signal we call the niche or the nice, depends on if you follow the English or the French version. The niche standing for news with insightful categorical events. So basically means is we can further combine the signal computed event by event into one signal for company, for every single company. Right, so you do see again, the coverage is fairly complete for US, actually for non-US as well. I'll show you in a second. The signal on the correlation means how much it changes from time to time, given we're aggregating across large number of events. The signal actually have a fairly fairly sticky, so that means it changes a lot from day to day, which is related to the signal decay profile. I'll show you in a second. This slide is quite important, especially the upper right-hand side chart. When you look at the performance over time, you can definitely see this one is a lot more persistent over the years. Even in recent years, including 2018, 2019, the signal still performed reasonably well. We're also seeing a fairly nice and linear monotonic patterns, means companies rank higher tend to perform, in the future tend to perform better than the ones ranked lower. We also see the signals is fairly balanced on both long and short, so it means you can use it for both long and short. The most important one, I guess, I want to highlight is the signal not only cover U.S. market, actually also has a fairly decent coverage, even in emerging markets. Right, so we have about 1,500 companies in both global developed ex-US and also in emerging markets. Performance in both regions tend to be fairly strong. The most important message I want to highlight is really on this slide, the bottom two charts. These two charts tell us about how fast the signal decay over time. So the x-axis in both charts are really in months, and this is not cumulative, right? So this is really saying is if I compute my model today, what's the correlation between my signal versus the first month stock returns, the second month, the third month, all the way to the 12th month of stock returns. But so you can see, especially in the non-US market, the correlation with stock returns even 12 months down the road is over 1.5%. This is actually still stronger than the sentiment signal direct off the shelf. Right? So the signal does have a fairly long investment horizon, so you don't have to trade it every single day to capture the alpha. From a country basis, when you look at the upper right-hand side chart, you can see the signal performed the best in some of the biggest regions. So for example, US, Europe, UK, Asia, and this is where you're seeing the strongest performance. Obviously, there's not only in these regions, number one, English is widely spoken and widely used. Number two is you do have a large number of stocks that also give us that diversification benefit. On the other side, you can see the models tend to struggle in the smaller countries, let's say Canada, Australia, also tend to struggle in Japan and China, where English is not the main language being used. Right, so it does have some further areas we need to improve in the future. So I think this is sort of a one quick summary. But last slide, I want to conclude on the equity side of things. We do find again the signal build using the new sentiment and also social media tend to be highly complementary with some of our existing models. But also, when you look at the correlation of the niche with of the traditional signals, it does show some modest correlation with growth and momentum signals. But more importantly, when you look at this slide, especially when we're doing the attribution analysis at the bottom two charts, right? So if you look at the bottom left-hand side chart, the blue line shows you the active performance of the signal over time in the past about a decade or so. We can separate that performance into what is related to the common known factors and what is residual. Residual is obviously more important. This is real alpha or orthogonal alpha driven from the sentiment and also machine learning part. When you look at the bottom right, you do see again is the signal does take a positive tilt on earnings revisions, has a positive exposure to price momentums and profitabilities and so on and so forth. So part of the signal performance definitely comes from your traditional factors, which is probably not that important because you can capture that with your traditional factors. But the residual alpha is actually even stronger than the traditional exposures. And this is, again, when you look at the purple lines on the bottom left-hand side chart. On the purple line, this is our residual alphas that delivers not only stronger returns than the traditional factor, which is green, but also has a much lower volatility. So the Sharpe ratio of the residual alpha obviously is stronger than our traditional factors. But even more so, when you look at the recent years, so this again mostly from 2018 to 2019, the purple line remained fairly strong going up versus the traditional signal, which is the green line has been flattening out in the recent months, it actually has been declining. So this again highlighting the diversification benefit coming from alternative data, coming from news, from NLP kind of analysis.
I think these were some very interesting insights to how you can make the signal work on longer horizons, taking advantage of more granular information from the Ravenpack data set. Of course, this particular example or studies that you presented here were focused on equities. But what are the other areas where NLP and sentiment analysis could also be useful? Have you gone beyond equities in some of your research?
Yeah, no, that's a very good question, Peter. I think this is definitely one thing I think we can do even more. Right, so most of the sentiment work, most of the sentiment-related research and also data advantage we have seen in recent years tend to be predominantly in the equity world. And this is actually one thing we quite interested in the Ravenpack data is not only you have a coverage on traditional equity, but also even more so in the macro world, which we're starting to do more and more work. So this is a sort of a white paper we call it trade wars and Brexit is a sort of a simple example of how we can use the news and related sentiment data in the macro world. We actually also tie in back into the equity world, so you can use both in trading macro instruments. You can also use in the equity world as well. This is one of the probably most popular questions we're hearing from our clients in recent months. Is again, if you are sort of a typical equity investors, right? So if you don't have any specific views on the trade wars or the Brexit, then this is probably more like a risk factor, or of how do I actually measure my portfolio's risk to the trade wars and the Brexit, and then number two, how do I actually hedge it if I do have a significant exposures. If you're macro investors, again, you may want to take a directional view or taking a directional bets. But unfortunately, the trade wars and Brexit are not tradable instruments. Right? So if I do have a specific view, if I do believe I have a specific knowledge about, let's say, the development of a Brexit, but how do I actually trade it? If I know it's going to resolve either positively or negatively in certain time horizons, how do I actually pick up the investable instruments and to take advantage of my views on sort of a geopolitical risk events? So this is again where we can actually use the new sentiment data, actually trying to develop either hedging or tradable strategies using the macro sentiment. The way we do this on this slide, I will show you two simple examples. So let's focus on the U.S. and China trade war. Right, so we are taking advantage of the Ravenpack database. We have constructed two macro indices. The first one is the orange line, we call the global trade conflicts. So this one is non-directional. We're just trying to measure the uncertainties or the conflicts, uncertainties around the trade conflicts. This is mostly event counts. We're just counting for the news event related to trade conflicts, related to trade wars, related to tariffs, and so on and so forth. The second one, which is probably even more interesting, is really by bringing not only just the uncertainties, but also the sentiment. And this is again, we have a track every single news event and to see how they are related to, are they really related to US and China, and then also the trade wars. And number two is if the news is actually related to the trade wars, as a report on the right is a bullish or bearish about a sentiment. Right, so this is actually quite important, give you that directions. You do see again, for example, in recent months, and this is actually around November last year, there was a big positive spike, and that was around the G20 meetings when both countries agreed to a temporary trade truce. Right, so you can sort of see, so most of the time, the sentiment is probably hovering around zero, but it does show a big spike either positively or negatively. And we do the same thing for the Brexit index. So the first step we do is we're developing these macro indices. The second step is we can also computing every single asset sensitivities to the specific trade sentiment index. We can do this in two ways. One is a top-down approach. One is a bottom-up aggregation approach. So what we typically do is for the macro instruments, such as the country indices, the ETFs and futures, currencies, we typically take a top-down approach. The top-down approach is typically estimated using a state space models where we're assuming the relationship can be time varying. Right, so this is actually quite important because let's say we're taking the Chinese currency. It's not necessarily always positively related or negatively related to the trade war. It also depends on investors' reactions to the news. This again related to the argument I made earlier about of inequity world, right? So we assuming that relationship can be time varying, right? So this again, you typically use a time series approach, or we follow a state space model. The model is estimated using Kalman filter. This is a simple example. This is the current estimated coefficient. Basically means is how the various asset classes varies based on the trade wars. For example, you can see the bottom left-hand side chart. If the trade war evolve in a positive directions, most of the commodities tend to react positively, not surprisingly. If the trade war is resolved in a positive ways, the global economy will probably continue to expand, at least will slow down, will reduce the uncertainties where commodities tend to outperform. The same argument, and when you look at the coefficient estimated at the currency levels, you see The yellow bars is how they're reacting to Brexit. Obviously, British pound or the GBP tend to outperform when the Brexit develops in a positive way versus Chinese yuan tend to perform well when the trade war develops in a positive way. So most of the results are fairly intuitive. And we also do the same thing at a single stock level. Actually, this is a lot more challenging. The reason is we have a dimensionality problem. Let's say we try to estimate every single stock in the US or in China against a trade war. We have 1,000 stocks. We have only one macro index. We do the time series analysis. We try estimating this beta. Obviously, the beta can be, most companies are probably have very little exposure to the trade war. So we have a lot of estimation errors. The Brexit is potentially less problematic because for most UK companies, for many European companies, they probably do have significant exposures to the Brexit development. But in other cases, we're seeing the dimensionality is a big problem. So this is where we use our machine learning technique again. We're using ElasticNet technique, which is basically a shrinkage estimates. Right, so we do this time series analysis. We're estimating every single company's exposures. The two charts at the bottom shows you the correlation of the thematic baskets versus future sentiment of development. Right, so if you estimate it's 100% accurate, if you're buying the companies with a positive sentiment, you're selling or shorting the ones with a negative sentiment. If next day, next month, next week, the sentiment does turn out to be positive, your portfolio should outperform. Right, so this is basically design is almost like a backtesting to see how accurate our estimated beta is related to these macro events. But also trying to understand is what is the optimal size of our basket to track these macro events. So if you don't have a specific views, you can use these as a hedging instrument. If you do have a specific view, you can obviously trade these baskets to take advantage of your macro views. Given that most U.S. companies probably not have a tremendous exposure to the trade war, you do see again the bottom left of the chart seems to show a basket of 30 or 60 stocks probably sufficient. Versus Brexit, again, most UK companies are probably exposed to the trade union discussions. You do see again we probably need a bigger basket to capture this macro development, but also give us enough of diversification benefit. All right, so that's a sort of a quick summary, I think, is again, we briefly mentioned about how we can use the NLP analysis in the single stock world. The main goal is extending the holding horizon, investment horizon by interacting with corporate events, with investor behavior biases using machine learning technique. The second one I briefly mentioned about is in the macro world, again, also involved in a few steps, but we do take advantage of real impact data to construct our macro indices. Once we have these macro indices, we can track for, let's say, currencies and commodity exposures to the macro events. So as a macro investor, you can use it directly. For equity investors, again, if you have a specific view, you can also trade these thematic baskets. Most equity investors probably don't have a specific views on political events, so this is more for hedging purposes. So with that, Peter, let me turn back over to you.
Thank you very much, Yen, for your interesting insights. I personally get very excited when I see research on the macro side, and I think you did some very interesting examples here for hedging purposes in particular. And I think at this stage, we'd like to turn it over to the audience to see if there are any questions there. I'm sure we can have an interesting discussion for the rest of the webinar based on what they have of questions for us. Thank you. Yeah, so while we wait for the first few questions popping in, I'd like to mention as well that Ravenpack is having their annual London event taking place on May 23rd. So please keep that in mind. If you'd like to learn about more use cases for the Ravenpack dataset or sentiment analysis in general. You can, of course, find more information on our website. You can sign up and join the event in there. And now let's turn over to some of the questions that have come in. I think one of the first questions that popped in early in during the presentation was how do you distinguish between information and noise from both social media and news? Like there's probably a lot of social media probably has a lot of noise in it. So how do you go about dealing with these type of things? So I think that's it's a very interesting question. Of course, for sure, there's a lot of noise in social media data in particular, and of course there will always be some noise in news data as well. I think the way that we go about it from a RavenPack perspective is more that we try to structure the content and provide as many analytics as possible that you can use for filtering purposes. So for instance, we do event detection as an example. And of course, what is noise and what is information depends really on your application, right? So you could either trade off particular events and understand which ones are relevant for my particular use case. And then at that point, everything else is more or less noise from a pure prediction point of view. When it comes to social media, for sure, it's going to be much more risky to event trade because there could be a lot of, can you say, low quality or less reputable sources that provides the events. So either you could go for like a whitelist approach, such that you only will listen to more official channels of information also via social media, or what a lot of people would also be doing is to aggregate and try to take let's say a sentiment trend over a time period where hopefully the noise will cancel out, and what you will have left is a signal that will still provide you with some predictability for whatever you're targeting. We also have other questions come in, and one of them relates to macro applications. So Yin, you already covered some macro related applications. Are there any other things that you have been working on that could be applied to the macro space, from the RavenPack data? I think we might have some technical issues. We might have lost Yen in the process. So I will keep going here on the questions. I hope you can hear me, all of you. So in terms of macro, there is for sure less research available on the macro space. Most of, can you say, the early research that was done was applied more to equities markets, but in the last, can you say, 5 years or so, there's been a lot more interest on the macro side, and therefore also more and more applications are turning up. We have seen use cases in crude oil, or so for in the commodity space in general, but also for currencies, we see a lot of interesting use cases. I would say generally that macro is probably a little bit more of a challenging space when you work with alternative data in general, mostly because in the equity space it's easier to link information. Let's say if there's some news on a company, that it's going to be relevant to the company in some sort of way. However, if you look at macro, most of the time you have to make some sort of inference. Most of the time when a currency is mentioned, it's often not really moving the currency price, as a lot of the news is really about how the currency moved. So you need to make inference, for instance, for macro data and so on. And furthermore, you obviously also have the challenge that you can trade a smaller universe of names, and therefore are able to get, or you're not able to get the same level of diversification across your portfolio. However, we are seeing a lot of success in the currency space and in the commodity space in particular, and also actually around sovereign debt and these type of areas. But where you start to look into perhaps economic sentiment and focus on, let's say, guidance around GDP or guidance around employment and these type of things. So you try to capture more forward-looking views on more traditional data points as well. And in particular for commodities, they probably are the ones that look most like like equities themselves, where you actually do have news that mention the commodity itself. So there's a lot of different kinds of applications that that you can use in the macro space. Let's see what else is coming in. That was, I guess, a fairly long answer. It says here that NLP seems to work best for short-term trading for hedge funds. What sentiment signals works best for intermediate and longer-term investments? Or stated in another way, what type of sentiment signal decays slower? I think that's also a very good question, and if Yen is back online, feel free to kind of shout out. But otherwise, I will carry on. I think it's a very good question, and I think, you know, generally speaking, I think sentiment is a faster moving signal if you look at it, can you say, in a simple way. Most people that have been successful in longer term applications are trying to combine it and slow down the signal by combining it with other information. So it becomes more of either a confirming signal or some sort of a filter. So you might be looking at, and we actually covered that as part of a previous webinar, where you use it as a filter on top of a factor, let's say a value factor. So you might use sentiment to understand when is a company cheap for a reason, and therefore you shouldn't be buying it. So you can kind of address like not entering into a value trap, or you can enhance a momentum signal. You know, when is momentum running out? It may well be when there's been a lot of bad press. So you can kind of enhance existing signals or combine it with data that will slow it down. Or you can also start to go into more sophisticated hypotheses and only use, let's say, a subset of the Ravenpack data set available. So you can build strategies around, you know, buybacks or capex and these type of things, where you, as I mentioned, go to very, very strong hypothesis-driven signal, and they tend to last longer, generally, depending on, of course, the sophistication of your hypothesis. And what we're also seeing is that it may be that there is a shorter-term reaction which is following sentiment. So sentiment is let's call it a momentum signal. So positive sentiment leads to outperformance. Negative sentiment generally leads to underperformance. But also, as Jens showed, there may be, let's say, on the negative side, there may be a shorter-term reaction as a sell signal, but then you might have a longer term reversal. And it may be, if you are a longer term investor, that you want to capture that other side, that overreaction part, and therefore you kind of get the reversal. So for sure there are applications also for longer term investors, also as Yin showed today.
Yeah, no, Peter, let me try to see if I can get online. Can you hear me okay?
It's a little vague, your voice. So
all right, so let me just try to be very brief for that. I'm saying is I think the main theme of today's talk is also trying to understand the investment horizon of the new sentiment signal by overlaying with how investors react to the news, by better capturing either the reversal or the personalized drift.
Okay, thanks. There's also a question here on how would you solve the problem that there are too few news within a certain type when you run your machine learning models? I think I will start off with it, and then Yin, feel free to also jump in here. I think one of the challenges that you have, of course, is, you know, Ravenpack runs a very, very granular taxonomy. So we cover nearly 7,000 different types of granular events, but we all of the events belong to an overall taxonomy, so you can work at different level of granularity. So at the very top level, we have 5 topics, you know, business, economy, political, societal, and environmental news. And then you can dig deeper into group level, where you might be looking at, you know, 50, I think it's a little more than 50 groups. You have a couple of hundred types, and then the most granular information you have at the category level. So of course, the challenge becomes at what level of the taxonomy should you be working at. And it might be interesting, for instance, if you want to run a machine learning algorithm and you are interested in having more continuous data, time series data available, to roll it up into, let's say, group level, And perhaps for certain types you want to go down to, or for certain kinds of events, you want to go to type. For instance, in our case, it's always good to do that for corporate actions because there are many different kinds of corporate actions. But then you find that right level in the taxonomy that you want to work at, and then you can start to create additional features within each. So you might say, okay, I roll it up into earnings, but I want to be able to split into what might be related to guidance that is forecasts versus facts. Or you can split it up into positive or negative sentiment and so on. So you try to find some broader categories at a higher level in the taxonomy where you have enough volume. So it's really finding that right trade-off.
Yeah, no, I think this is sort of one of the benefits of using news data is we do actually have a decent sample size. Even if not, of course, there are also many techniques within machine learning with the smaller samples. For example, cross validation and just tracking is kind of techniques help us deal with smaller samples.
I think that there's a few other questions. We can probably still manage to do one or two here. Let me see here. There's a common argument. A common argument is that on the long horizon, news are incorporated in prices and or other data sources. What's the intuition in support of news sentiment as an incremental source of alpha? Why would news sentiment be still predictive conditioned on other sources? And that's of course is a very good question. And I will say that eventually, news information is incorporated in price. The question is just over what horizon, right? When eventually, if you aggregate sentiment in a very simple way, just take average sentiment over time periods and you start to increase your window, eventually you will converge on a momentum signal, which is not surprising. But the whole thing is to figure out when is sentiment not momentum. And even when you start working on fairly simple signals, you will still see that sentiment is not price for up to 1 to 3 months out. On top of that, you can start to do something more sophisticated where you are going more thematic about it and try to incorporate it in a different way. For instance, one thing I also tend to say is that it's also sometimes good to be able to tag a price move with some fundamental information. So it's not just about the sentiment, but also the themes that are taking place, because you might get a better idea of the future behavior if you can say that, okay, prices have been moved because there's been a lot of, reorganization issues or CEOs getting fired or there's been a lot of layoffs and so on. Instead of just seeing prices going down, it may be that there are different implications for future price moves. And for sure, what you will see is that in the shorter term or midterm, news sentiment is not price, and it's not even analyst revisions. But of course, you will see a positive correlation, but it surprises most people when they see the level of what the correlation really is. Most of the time, we are talking about 10, 20, 30% correlation at max with more traditional factors.
So I want to add a couple of things. When you see the news reporters and the social media comments, there's definitely some correlation with the investment community or the sales and analysts. So there's definitely a correlation between news sentiment and also the analyst sentiment. But we also seeing a significant differences. Again, just using my main research as example, saying is number one, when you think about a policy event drip, so once there is a reported revenue stories, we're looking for the ones that publish smaller news that investors tend to overlook, and then the smaller news tend to be repeating themselves, and that kind of a building up of a momentum effect. On the other hand, we can also capture this sort of a reversal effect, meaning the big and significant news generating lots of market attention, investors tend to overreact. So those are definitely one dimension. The news is priced in, but we're also trying to capture is the market overall underreacting to the news, which leading to either the post-announcement drip in the same direction or leading to reversal patterns. And those will tend to take much longer time to realize this is kind of a reason we say yes, it's kind of reflecting in the market and the price in, but market is not pricing the news in the proper way initially.
Well, thank you very much, Yin. I think at this stage we will probably have to wrap it up. As I mentioned, if you're interested in hearing more about applications, feel free to go to our website and check out our upcoming symposium in London on May 23rd. Unfortunately, we weren't able to cover all of the questions that were posted today. We will try and follow up after the event and answer as many of them as we can. We'll make sure to shoot them over to Yen as well to get his views and opinions. So again, thank you very much to all of you. We will inform you when we have our next webinar happening, and we hope that you have enjoyed listening in, and that you are also willing and interested in listening to any of our future webinars. Thank you very much, and have a nice day to all of you.
This is Raven Pack.